become the finance secretary to the government of India. He was closely associated with major economic policy measures, including bank nationalization and poverty alleviation, and later retired as executive director of the Asian Development Bank. His career is a reminder that economics and public policy ultimately derive their meaning from their impact on people, institutions, and the broader economy. I must also acknowledge with deep respect and admiration the presence of Dr. C. Rangarajan. His contributions to Indian economic thinking, monetary policy, financial sector reform, and institution building occupy a distinguished place in the annals of our economic history. His long stewardship of the Reserve Bank, marked by scholarship, judgment, and institutional commitment, has become part of our professional folklore. It is truly humbling to be speaking in his presence today, and we are grateful for the distinction he lends to this occasion. Thank you, sir. I speak today in the presence of eminent economists, the members of family of Sri Ramachandran, and also the students of economics. I do so not as a professional economist, but as a career banker and a banking supervisor. So my perspective is therefore that of a practitioner. I have great respect for economic theory. I have even greater respect for what happens when theory meets reality. The subject on which I wish to speak today is on learning, judgment, and supervision. The lessons from my own banking career. So my core theme is that banking cannot be understood only through numbers, models, or regulations, though all three are important. It must also be understood through experience, institutional behavior, and the public purpose that finance is meant to serve. In that sense, a life in banking has offered me three educations. The education of the classroom, the education of the banking counter, and the education of supervision. Each offers a different lens, and together they have helped me understand banking more comprehensively. It is this experience that I would like to share, especially with the students gathered here today. So let me begin with the classroom. Economics first came to me through examination papers, like many of you would have encountered, through examination papers in school and college. The themes were in many ways evergreen. Demand and supply, money and banking, public finance, international trade, national income, and business cycles. These are the most familiar themes all of us had. Like many students, I understood them well enough to write and clear examinations, but I do not think at that stage I fully appreciated how deeply they would later shape my understanding of banking and finance. It was only when I entered banking that many of these ideas acquired life. Demand and supply were no longer only curves in a textbook. They could be seen in the appetite for credit, in the pricing of funds, and in the behavior of our borrowers. Money and banking, which had once been a paper in the curriculum, became the world in which I worked every day. That is why I say, with the benefit of hindsight, that a good education in economics is a powerful thing. It teaches you to ask questions that are simple in form but deep in consequence. What are the incentives? Who bears the cost? Who receives the benefit? What happens if a rule changes? What are the unintended consequences and these options as compared to what? So take banking. The bank is not merely a building, not a balance sheet, not an app on your phone, as several of the current generation would believe that the bank is an app. It is an app, but then it is not just that. A bank is, as I see it, a bank is a bundle of promises. It promises depositors that their money will be safe and available when needed. It promises borrowers that the credit will be available on fair terms. It promises shareholders that capital will be safe. It promises the regulator that it will conduct itself prudently. Finally, in a country like India, banks also carry a broader developmental expectation to support inclusive economic growth. So economics helps us understand these promises better. It gives us concepts such as moral hazard, adverse selection, information asymmetry, and systemic risk. These are not merely academic expressions. They are everyday realities in banking. Moral hazard appears when an institution takes excessive risk because it believes someone else will bear the consequences. Adverse selection occurs when a lender, unable to fully distinguish between a good and bad risk, ends up attracting weaker asset quality. Information asymmetry creeps in when the bank does not get to know the true financial position of the borrower. Systemic risk can arise when the failure of one institution damages public confidence in many others. The classroom gives us the language to understand these realities. Practice teaches us how they appear in real life. The financial system is not made up of variables alone. It is shaped by people, institutions, incentives, habits, cultures, memories, and fears, and at times greed. That is why the classroom, valuable as it is, must be complemented by experience. So this brings me to the second education, which is the banking counter. For many bankers of my generation, banking began at a branch. Customers at the counter, vouchers of various colors and hues, ledgers, cash books, loan applications in paper files, site visits, and credit proposals that had to be examined not as classroom exercise or not on a computer, but in actual practice. It was also a period when banking was beginning to change. As I was mentioning to Dr. in the morning, the recommendations of Dr. Rangarajan's committee, or the two of them, helped usher in the early phase of bank computerization. And ALPMs, many of you may not be familiar with that terminology, today, the current generation, the ALPMs became one of the visible symbols of that transition. But my subject today is not computerization. We will reserve that for another day. It's about something more basic and perhaps more enduring. The first lesson one learns in banking is that it is not only about money, accounting, or procedures. It's about judgment. Credit is a judgment about the future. For example, will this borrower repay? Will this business generate the cash flows it has projected? Is the collateral worth what it is claimed to be? Is the promoter being realistic, optimistic, or over-expansive? These questions cannot be answered with certainty as the risks appear from the way the borrower presents his accounts, in the assumptions behind the project, in the enthusiasm of a relationship manager. They require analysis, but also a gut feel for people, market, and institutions. After seeing enough loan proposals, borrower meetings, and credit committee discussions, one notices the signals. A business that is profitable on paper, but constantly short of cash. A borrower who explains everyday delay as temporary. A credit proposal that relies more on collateral than on cash flows. A loan book that grows faster than the bank can monitor. Each tells you something.
Ramachandran family, faculty, students, and staff. I'm indeed very happy to be with you all this morning on the occasion of the 12th G. Ramachandran Memorial Lecture. Mr. Ramachandran was an outstanding administrator. He had a brilliant academic record, followed by topping the IAS exam. I was also a student of Rangarajan College, but I didn't get to know him because he was several years ahead of me. But he was a role model for all students at that time. As a distinguished administrator, he had the opportunity to hold key positions both at the state level and at the center. This gave him an opportunity to give shape to critical economic policies that India needed in those days. What is the role of an administrator? A good administrator is one who places before the political leadership, which has to take the decision, the pros and cons of every problem that comes before it, and lay out the alternatives before the political leadership. It is often said by some that the members of the Indian Administrative Service are all cautious. But it is also said not only about IAS people, but the entire government servants, that they are all trained to do what? As they say, to do things rightly rather than do right things. That is a real problem. A good administrator must be a thinking administrator. An administrator who can, as I said earlier, look at alternatives and make the right suggestion. I think it was fortunate that we had distinguished administrators like G. Ramachandran. And I would also say that I had no opportunity to know him that well. But as was mentioned by Ganapati, when I was governor of the Reserve Bank, he was nominated as member on the board of directors. And he came to the board meetings always fully read and with all alternatives and insights on the problems that were coming up before the board. Therefore, the members of the board looked forward to what his comments were going to be. And that was an important contribution that he made post-retirement to the development of the country. G. Ramachandran completes 99 years with this year. The next year is going to be very significant. It will be a centenary year. And we will discuss with Mr. Ganapati and his family members as to how to deal, what to do with it. I'm also extremely happy that Mr. Swaminathan accepted an invitation to deliver the memorial lecture today. I have also not known him that well, but I read his lectures, which are printed in the RBI bulletin. I must tell you, these lectures usually are not that lengthy, but they are crisp, and I would say the simplicity of the style is very attractive. I recently read 2 articles